Welcome to this conversation on Business Redefined. Now, last week we promised you we'd be giving you part 2 of Project Oil Kenya 10 years later, but big news happened. The CMA released the draft regulations on public offers, listings and disclosures for 2022, and we want just to digress a bit and talk about that. We shall be back with the issue on oil next week, but we are privileged to have Mr. Wycliffe Shamia, the CEO of CMA. Welcome on set, sir.
Thank you. Thank you.
Always a delight to have you. The draft regulations on public issuances, listings and disclosures, one of the anchor, having read through them, is that you want to catalyze listings. Let's start from here. In your own assessment, how much has the regulatory environment been an inhibiting factor to entities going public?
Thank you, Julian. I think that's a very important starting point of our discussion. And if you realize, in our short-term strategies back in 2020, we spoke about looking at the legal framework that will actually catalyze issuances and raising of funds from the market. And this has been our struggle for the last, say, few months, particularly because we felt from the reports which we have so far, studies, among the key hindrance to people raising money from the capital markets were the current requirements. And therefore it was important for us to look at that and even take advantage of the new developments within markets so that we, of course, update our markets. You know very well, the current regulations were done in 2002. They are nearly 20 years old. Things have since changed. Now, if you look at the requirements in the current dispensation, sometimes, perhaps, when they are being set, they had certain things to take care of. However, with the developments we've seen in markets, there was need to relax some and introduce some. For instance, if you look at the financial ratio requirements for a company to raise funds, whether it was looking forward to list on the main market segment, which we call MIMS, main investment market segment, the requirements really, of course, threw out most of the other companies that would like to list, because we were looking at their share capital mainly, net assets, and then many other things. The threshold was a bit high, and therefore we felt perhaps we change the target to a more practical kind of like aspect. But again, just to mention, we have had issues in how many market segments do we have, because we are having new products being issued. And the problem is maybe the current setup of boards segments has not been much flexible. So it was high time again to look at, so how do you cater for those so that there are no adjustments to regulations whenever you have new products. But from issuer's point, I think the main point was, for you to raise money from capital markets, you had to be a company, a corporate setup. We are trying to adjust in the space where we now have new entities that can issue instruments and also raise capital in the capital markets, and therefore it was critical we look at this. But then in the regulations which have been on, you realize important aspects like credit trading for certain instruments was not mandatory, and we were feeling, although as regulators we play the role of protecting investors, they need to have enough information, disclosures, so they make decisions based on those disclosures. Some of those could be credit rating reports, which I think has not been mandatory for certain issuances.
Can I just hold you there, because you're unpacking quite a bit and I'd like us to go bit by bit on them. So let's start from this point. When I read the draft regulations, you want to widen the purview beyond entities registered under the Companies Act. What spectrum of categories do you see potentially coming on board? I'm imagining LLPs would be in consideration here.
Yes, exactly. I think the intention is to have entities that can, of course, be formed and shares traded of sorts. So most likely it will be LLPs. But as we speak about special purpose vehicles, we also realize they can take different forms. There are those that are, of course, unit trusts. There are those that are corporates. Now we see some taking the LLP form. So I guess the newest which we expect will be LLB, mainly just in addition to corporates which are registered. But importantly, we have insisted that even when you are a company, it should be locally incorporated. But you realize there are certain supranationals which can issue instruments here. They don't need to be locally registered. You know, that is another layer we want to get rid of. But again, I think if you look at the government issuances, you know, state corporations, unless you are incorporated as a company, you need to go through so many other processes before you can issue or raise money from the public. So sort of we want to see how do we tackle this so that it's an issue where it's more open, even as we look at the smaller companies within our market.
Okay. And the discussion around ratios, if you look at the regulations as it is right now, the provision is that for you to be eligible to list in the main segment, you need net assets, not less than 100 million, I think. The proposal is to shift this to total assets of at least 1 billion shillings. Yes. I thought through this and I was asking myself, is the market regulator trying to create some breathing space for companies which might be having significant debt to come to market?
Well, over time, I think from experience, when you look at the net asset ratio, of course, you assume the companies are coming from certain sectors. But we also agree that there are certain sectors where debt is so crucial. The company may be very healthy in terms of operations, but they are putting a lot of debt. So if you base your assessment on net assets, it's very likely maybe the company could be struggling in that sense. But in real sense, if you look at the operations, the balance sheet itself, it is strong enough to allow the company to raise money in capital markets. And I'll say this, if you look at the banking sector, for example, there are certain other sectors where you require quite very huge capital outlay, and therefore it comes in form of debt. So if you look at the ratio on net assets, you'll have a problem. And I think what we have seen in the past, most of those who were strong enough and they were having those issues, we had to give them exemptions. What we see important is we look at the other ratios which will be very critical in those respective sectors. So how are they measuring up against those other ratios other than the one which is prescribed? So we found total assets is a good measure because then you are looking at how is the best of the company. Then the other factors can come in just to support and ensure that the quality of the company which wants to raise money is as good as it should be.
Okay. Looking at the profitability requirements, there's also a proposed change on that side. Currently, you should have been in operation for at least 5 years, I think 3 of which you should have at least registered a profit. If you look at the proposed regulations, out of 5, I think it's 1.
Yes.
Why would you downgrade the profitability benchmark by that margin?
So making losses and profits in real life, I think, is a reality. And sometimes you may be having challenges in 1 year, and then, of course, you pick up in the next year. We found if you insist on profit record for a long time, again, you disadvantage companies that should actually rightly raise money from the market. And I'll give you a very good example. A company which is struggling is supposed maybe to benefit from injection from its own shareholders. And perhaps maybe you're looking at a rights issue. Now, if you retain the current requirements as is, and of course the company is making losses, they don't have an option of getting even those injections from the current shareholders. So for us is, I think, the assessment which gives comfort that although the company has not made profits, is a quality asset as far as the investment is concerned. So we are looking at the other factors that are very important. For example, for us, what is very important: governance, management, and of course the business outlay. It doesn't mean profitability is not a very critical factor, but we are saying perhaps we can lower that standard so that we allow, if it is once, and then of course the company can raise money from the market.
Aren't you worried by the potential perverse outcome of undermining the quality of listings that could potentially come on board?
Before you allow a company to raise money, I think there are other things we request and we insist on. Valuation, which is one of the areas which we have also relisted.
I'll be coming there next.
Yeah, so valuation of the company also gives a rough idea, other than just the profitability scale, that then this is what the company is worth of. So in a nutshell, what I'm saying, there will be other sources of disclosures that will give you comfort that you require even when the company is showing losses, that maybe it may not be that very bad.
I see. Mr. Shami, there are entities which in the past have gone public, and we have eventually ended up asking, did the company go public at the wrong valuation? And of course, reading through the regulation, I think in my understanding, there's a bit of a shift from the traditional book building reliance. Could you please just comment on the proposal?
Yes, thank you. A very important question. Valuation is very important because I think there are experts who should do valuations and then inform investors what is the correct value, roughly, of a certain asset, so that you can see their justification for the offer price, for instance. Valuation can be anything. Unfortunately, if you look at that area in terms of discussion, you find we can attach different values to different things. Different people can attach different values on the same thing, and therefore it becomes very fluid. Now, what we have seen, the theoretical kind of valuations we have received are usually put to test when a company is listed. Because this is now when you get the investors coming in and saying, in my view, this is the price I attach to this asset. Now, sometimes it looks unfair because, for instance, if you looked at the companies listed on Nairobi Securities Exchange, you will see some companies which are huge in magnitude in terms of assets, but you look at their price, it is not comparable to some which are even smaller. But there are many factors. So true, it looks like in most cases, the valuation which we have seen in the past on most of the IPOs, from the trends we've seen after the shares have been listed, will indicate that perhaps maybe the value wasn't the right value. But I think it is just the perception of investors. Many factors come to a play because once you go to market, there are those who want to lock out of the share at any price, lower, because of certain other needs. So there will be quite a number of factors that could also result in the situation we've seen in the past. Otherwise, valuations that we want will be valuations that are done by professionals who are trained in that field. Of course, we have had very good valuations in the past, but as I said, there are quite a number of assumptions, there are many factors, there are different disclosures that you may require if you have to do valuations. Whether you got those disclosures, I think those are the questions we have had in the past.
I see. One of the key highlights for me in the draft regulations is the special purpose acquisition entities. And why this is of interest to me is because I think it is one bullet trying to shoot at a couple of things. Let's start with the aspect of cost. Many potential players in this market have told you the costs just don't make sense. CMA has recently argued that SPACs would have a stronger cost proposition. Could you just give us more flavor into that?
So when you talk about special purpose acquisition companies, SPACs as we know them, it's a new creation which has worked very well in certain markets. And these are entities who don't have a past record in terms of performance, assets, but they are set up to do certain things. And because of the expertise that comes with the structure, they are able to raise monies and then channel into the ventures which they want. Some will be acquisitions of companies that are not performing, which have very high potential. And they have been very successful in certain jurisdictions. So we are trying to introduce that option so that where maybe certain companies, entities on their own, they may not have the capabilities of raising funds directly. There are options of other people with ideas of raising monies. They have the ideas, they don't have money, funds. Them raising funds, then these funds are then channeled into these entities which are not, of course, able to raise the funds. But where we've seen an advantage is the capability of SPACs raising money, huge monies, and then investing in different ventures. So there are, let me say, economies of scale when you look at it in terms of cost. Because, I mean, if you do one issuance, you are using the same prospectors, the same team, as opposed to if you are supporting 3 entities, they will have had all those in different, separate sects. So SPAC is seen as one of those ways, if used, being very economical in raising funds from the markets, and then using this money to distribute into these ventures that are very needy, and they could not raise these monies on their own. Yeah.
Still on SPACs, is SPACs an indication that CMA might be observing that this market has a market concentration problem? We've got some very few strong and investment-grade entities, which if they went to market to raise capital, they would definitely have no problem. Then we have this long tail, which would want to raise capital, but because of perception and fundamentals, they might not be able to. So these strong ones can then set up these entities.
Exactly.
And help address this.
Yes, although it was not the direct intention, but that could happen because we know of certain companies that have certain reputations and they'll raise money anytime. And because of that advantage, it's an option to them. They may choose to raise the money very easily from the market and then, of course, disperse it as they want. So in the process, because most likely there will be very huge companies, it could address the issue of over-concentration when you look at the few securities that we see very active at the Nairobi Securities Exchange. So it could be. Where we have seen SPACs very successful, actually would be cases where certain individuals, persons have certain ideas, but they don't have the funds. They are approaching investors and telling them, we may not have a past record, but we are willing to do what is best for you as far as business is concerned, investment. If you trust us, give us this money. So this could get into entities that require funds, but of course, they didn't have the option of raising the funds directly themselves.
Okay. Is Sparks also an attempt at trying to countervail the sort of thunder we've seen in the private transactions, the private equity M&As happening, whereby you see entities which really could have gone to market to raise capital, but because they have found a much smoother, a lot easier process on the other side, we just don't see them coming to market?
Well, again, I can say yes, it can happen. It is a possibility that Sparks could serve more or less the same role as PEs, for example, private equity funds. Our intention is not to counter. I think what we are saying is these are options because they play certain roles within the economy. So for us is widening the bracket of those who can serve, these companies that require funds. It is true, a company which could not have raised money very easily can consider whether they want to approach a PE or they raise the money through a SPAC arrangement. So that is also very possible.
Okay. Closing the SPACs conversation. The world over, if you look at the reviews of the special purpose acquisition entities, is that there is the risk that shell companies could be set up and then they end up toxifying the market. Does that concern you?
Yes, it does. And I think even from practice, as you say, we know that fear is there. But if you look at the provisions in the draft regulations, they are very robust in terms of just ensuring the companies that want to benefit from the entry through SPACs are genuine investors who want to promote, whatever developments they have seen, identified. Very specific and stringent requirements for you to raise money as SPAC. I think if you look at the regulations, even in terms of share capital, you realize it's not just a very low figure, it's quite a very high figure, 1 billion Kenya shillings. It's quite a lot of money. Then the other considerations who are behind, of course, what are your operations like, what are of course, what are your objectives. This is where we'll focus a lot of efforts as regulators when assessing those applications, just to find out what is the intention. And of course, your business projections will be very important for us as we make those decisions. So we are aware of that risk, but the draft provisions sort of take care. But we want also to balance the issue of investor protection on one end and then market development, because I think that becomes a challenge as it is for us as regulators. Sometimes we look into so much market protection, then obviously you destroy the same market you are trying to develop.
Speaking about potential overreach in market protection, I want us to cross over to the public restricted offers and the provisions in the draft regulations. I read them and thought this might be just a bit too stringent. If you want to go to a private offer, first you must identify the offerees by name. Elsewhere in the world, if you look at how they're structured, there is almost a metric or threshold developed for an accredited investor for a private transaction. Don't you think we could have better gone that side as opposed to?
Well, a lot of thoughts have gone into this, and if you look at the same regulations, I think we have focused more on sophisticated investors with a threshold of 1 million Kenya shillings available for investment. Now, the markets where you have accredited investors, for example, the US, if you look at the requirements they have, for example, on your income, and of course your close relatives, it's a bit very high. So the role accredited investors play is a bit at a very high level. But just to say, if from the feedback we get from the public, if it is very necessary that we introduce and of course have specific standards which are not prohibitive, I think that will be what we will look at much more. The role of accredited investors, as you know, is you are an investor who fits in a certain definition, and therefore you are on your own. Of course, you get into products knowing you have capabilities to do research and other things, and therefore when you get into certain instruments which can have very high risk, I think you understand what we're getting into. Where we are, and of course the feedback we see from the market and the public, whereas we can have that assumption, I think we need to be very live to the fact that we are still developing, and therefore if we came with that threshold for now, there will be a class of people being there, but managing their interests vis-a-vis the rest of the investors can be very challenging. So, well, if we receive feedback on need to have, the sort of, accredited investors we see in other markets, we can consider having them also in the draft regulations.
So, Mr. Shami, I was sharing with a couple of friends regarding the provisions regarding private offers, and the view was that perhaps the draft regulations really overstep, because if you look at the challenges we've had in the private space, we've also had challenges in the regulated space, if I could say. How come we are seeing a disparity in terms of extremity, if I could say?
Well, if you look at the draft regulations, we've given quite a lot of freedom for those who are issuing in private markets. However, maybe in another set of regulations, not this one, especially when you are raising money from the group, which looks like a collective investment schemes, I think there are separate provisions which we have. Now, this was important because even during COVID-19, we saw, and even in the recent years, the role of private markets has really grown. And it grows because of the very innovative products we see. And therefore, the risks that come with those products, I think our interest is to see those who get into those products really understand what they are getting into. If you look at these draft regulations, we seem to acknowledge the fact that there are certain financial arrangements, negotiations that happen between persons which cannot be regulated very easily. So that bracket is left out so that we allow certain things to happen. But those which look like perhaps they are the instruments we know, I think we are saying we need to have more requirements in terms of this is what you need to do if you are issuing in the private markets.
Okay. Maybe my final question in that category. I struggle with the aspect of setting a threshold in terms of the minimum to determine the sophisticated investor. And why that is the case is because I could easily find, and not to disparage them or anything, a mama mboga in the streets who can easily mobilize $1 million shillings, but doesn't have proper visibility of the complexity of these products. Yes. But I could find an MSc finance student who cannot raise $1 million shillings, but actually understands this. So how and this might be tricky, but how do the regulations now cater for that?
A good question, because from practice, you remember in the current dispensation, we spoke about a high net worth individual. We spoke about sophisticated individuals, investors. The threshold was around 5 million. However, there have been discussions of, in certain products, if you retain 5 million, it is too high. You need to bring it down. The issue is how you balance the amount and the risk knowledge or literacy as far as risk is concerned, and understanding the products, as you say. Now, for you to have the same goal in a one standard fitting all is a bit very tricky. That is why we are looking at what is reasonable. Earlier on, our thoughts were, if you put it at a very high level, say 5 million, it just cuts off everyone who is down here, whether they have capabilities or not, and it is good for them. But from the responses and the feedbacks we've received, I think there is a feeling that you need to allow it, calm down, but you can't leave it free, because if you lower it so much, it loses the meaning and the role it has to play, because the issue is Mama Mboka, who you refer to. Yes, I think she needs to participate in the issuance and she should be free. However, there are risks which I think if she doesn't understand, we need to see how she's catered for. And perhaps maybe it comes to, do we have enough collective vehicles where such investors can invest through, other than taking risk on directly. On the other hand, for those who have knowledge, understanding, they understand the risks. I think if they don't have money of their own, we are now opening space for them to use their skill, their, of course, capabilities rightly, and of course, make a living out of that, so that they are also not left out. However, the issue of balancing those two, I think unless you have a cutoff, it becomes very tricky. And this happens in most markets. I think just looking at the jurisdictions where we looked at the precedents, it varies, and it depends on the class of investors you're interacting with.
Okay. Let's wrap up this conversation. I know you're really pressed for time. First, there are sweeping changes proposed for the current growth enterprise market segment. Could you just give us some highlights?
Well, I think the current growth enterprise market segment, GEMS as we know it,
yes,
has been mainly for introduction, listing by introduction.
correct.
So you come there for visibility, then of course the current shareholders are given, not even current shareholders, those shareholders who are in have an avenue of exiting, others coming in. I think that is the role. However, we realize there is a meaning which we lose, because those companies should be also able to raise funds. Not only coming for visibility and, of course, transferability of the shareholders, shareholdings, but they should have ability of raising funds as they list on that board. I think for me that is the main proposal we are having around GEMS, because the other issues around what are the standards, of course the issues of how do we manage how they operate, the issue of nomads, maybe being not very, of course, needed throughout the life of the listing, I think those are a bit minor. Okay. But the issue is, so if you have an SME listing on GEMS, what is the benefit? The benefit may not just be visibility and transferability of the shareholding. It should also allow this SME raise fund. And I think that is the critical point that is being introduced.
It really struck me that the draft regulations proposed that SMEs should be able to raise fixed income instruments.
Yes.
Interesting, because one, of course, we understand we're seeing a revival of Kenya's fixed income market. What level of hand-holding do you think will go into this before they are ready to issue debt and the market actually exhibits a sort of appetite? Yeah.
A good question, because one, I think we need to do a lot of sensitization. What we realize, most of these companies may not be aware that they can raise that little amount of funds from capital markets. The belief out there is capital markets, NSE is for big players. I think we need to do a lot of course, sensitization. The other part which we need to work on very seriously is the capability to structure the products, which then allow them to raise these funds. I think at one point, if you remember, the commercial paper market was very active, and it allowed companies to raise money very easily for working capital and other short-term kind of needs. These products should be available, and those who can structure. And if you go to the same regulations, we are also talking about who becomes an advisor, transaction advisor, because it has been very closed. So it will be upon all stakeholders to sensitize these SMEs that, of course, you can easily get someone who can assist you. However, I think the other very important point is how we discuss with those who are on the demand side to understand that an SME can be a safe investment. And therefore, you balance the two sides, the supply side and the demand side. Otherwise, you may bring in many people who have needs for funds, but you don't have many people who are willing to give them the funds. You still have a problem.
And at what price?
Yeah, and at what price? I think, and also the process, because for me, it is one thing saying you raise money, but you had a lot of trouble raising that money, it took too long. I think those are the issues we want to manage. So the issues of cost, the issues of making sure that these assets are safe enough, and then of course those who are coming in are protected. I think those are the issues we need to face right on.
Mr. Shamia, reading through the regulations, it looks to me like CMA is proposing to delegate some of its responsibilities. Could you just comment on that?
No, I think world over, when we talk about regulation, I think because of the burden, we also see emergence of self-regulatory organizations. And that model has worked well in certain jurisdictions. What it means is, as a regulator, we take the overall responsibility. But we have a criteria which we can use to assess an entity, and of course, once it satisfies the criteria, then we can delegate certain responsibilities to this entity, but with oversight kind of role. So they are the first line, and then of course we do the oversighting. And this is very important looking at our role in the market, because you realize we have several roles. Of course, we have the regulatory role, we have development, then we have other mandates which we have been given. And for example, one which plays out very easily is, given our roles in, say, coffee marketing, you'll find it's necessary for you to have an SRO who plays the key regulatory responsibilities in that market with your oversight kind of, supervision. So this happens every time, and it is because the first people on the first line understands the people you regulate even much better, and therefore they can assist you to do certain things, but you don't give up your role 100%. You still are responsible for regulation.
Okay. Maybe just a quick follow-on to that is that, doesn't that concern you? And it concerns me because having covered this market for a while now, if you remember the incidents we had around two banks and having issued bonds, and there was a ping pong as to whether this was a CBK oversight mandate or CMA oversight mandate, and this market is still debating that. Don't you think that's a bit dangerous?
Now, maybe when you look at the issue of self-regulatory organization, I think it is the same kind of sector, and of course the focus is along the same line. The two cases you refer to maybe were in different sectors and therefore different expectations and standards. So in that case, you have challenges where several regulators need to talk to each other, and that comes with challenges. In the setup where you have SRO, the SRO has very clear understanding of their role. And in fact, they should, in most cases, play alongside the expectation of the regulator. So the cases where you see there are certain things which fall here and not here, but you are sharing the common, maybe underlying, I think may not be the issue. However, this does not mean, therefore, the regulator just, of course, switches off completely. We still have, the oversighting role, and we take responsibility. So it is in our interest to ensure we have very clear visibility on what the SRO is doing on a daily basis.
All right. My final question, Mr. Shamia. Sometimes I really empathize with the capital market stakeholders like yourselves. If you look at globally, the global trend is that public listings are going down. They're just declining. But here we are really pushing this agenda of entities going public. Sometimes do you feel like you are behind the curve in terms of the evolution of capital markets?
Well, a very interesting question, which of course has some sense in it, because where you look at innovative products, maybe around ICT and some of the blockchain developments we've seen, you found most of the markets, capital markets players, not only capital markets, most of the sectors were left behind a bit, because these are developments which came on and they were very impactful compared to what we see in the very traditional structures that we have known that you describe. However, I think for us as capital markets, the issue is how you raise long-term funds. And I think we need to adjust with that understanding. I think the issue is, are we able to have that satisfied in an economy? So, for example, where I pointed out, we have the role of private equity funds. If they satisfy of course, companies wanting money in capital markets and they take on their development agendas, I think we should not see it as a loss. I think the issue is, are we being efficient in ensuring funding flows to the right sectors? I think that is a question we need to, of course, face. Otherwise, as far as innovations are concerned, I think we cannot deny it. It's a reality, because we are discussing issues of crowdfunding. That is raising money, which traditionally would have come in a different form. We are seeing, of course, the role of private equity funds. We can't say they are not playing an important role. The issue is they are still providing the long-term funds which are required. However, I think the environment in which this is being done is very critical. Do we have the safety? Is it something acceptable in certain setups? I think those are the issues we need to go into very clearly and see. Where the investor is losing in some form, I think we need to see how that can be addressed. If there are certain national concerns, I think we need to see how do we address those. So for us in capital markets, yes, I think striving for listing is something that we must continue doing, but of course with the understanding that times have changed and there are so many other changes within markets. And therefore, how do we flow with those changes?
Mr. Wycliffe Shamia, thank you so much for your time.